It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're tracking the shift in consumer spending on food. I'm here with Tematica Research Chief Investment Officer Chris Versace. He's back with us. It's good to see you.
Good to see you.
And your Goodbye has actually been a sort of a popular one here on Goodbye or Goodbye, and that is Costco. It's very popular on the Yahoo Finance platform as well. The shares are already up more than 60% over the past year. So let's get to why you like it here.
Sure.
And we've seen some shifts, like throughout the pandemic. Obviously, people were eating at home then they went back out again. Now they're going back home, it seems like.
Yeah, absolutely. You know, whether or not we measure up recent retail sales reports or we look at some of the survey data out there, people are, feeling the pinch of continued higher prices and they're shifting back home. Probably the best data point I can give you on this, Julie, is something new from the Philly Fed. They put out all these different surveys, and it shows that about 43% of consumers surveyed are clamping down on discretionary spending, particularly eating out. So I think this is a great way to play it, and I say this because most people don't think about this. Costco gets about 54% of its product revenue from fresh foods, food and sundries. So it's extremely well positioned. It's also the largest seller of beef in the world, but that's beside the point.
Wow, I did not know that. Okay, so there you go. So if people aren't going out to eat a steak, they want to save some money, they're throwing that steak on the grill at home. Secondly, you think they're taking consumer wallet share. And this is sort of part and parcel, right? Because they are seen as a value within this whole chain.
There is no debate about this. So, the great thing about Costco is it reports monthly sales, right? So you can take a look at what their comp sales are. You can take a look at what they are on an adjusted basis. Then all you have to do is measure them up against what we see from the Commerce Department with the monthly retail sales report. And when you do this, there's no question Costco is taking wallet share.
Interesting. And how are they doing that? Is it the value proposition, or are there other things going on?
I think it's the value proposition primarily. I would say I'm going there for the hot dog at $1.50, but it's more of extending the disposable dollars that you do have. And if you've been to Costco, you know that it's extremely hard to beat. They've done a great job, like we kind of talked about, leaning into grocery. Just size up what Kroger said today against what we see with Costco. And again, they're clearly taking share.
Okay, and then finally, they haven't raised the fee yet. Everybody's waiting for it to happen, the membership fee to go higher.
Yeah, they have roughly 75 million, memberships out there. At some point, they are going to raise this, whether it's $5, $10, to you and me and everybody else who shops there, no big deal. But for them, across the entire membership, that's a huge number. And the key here is that this high margin membership fee revenue stream is about 50, depending on the quarter, 60% of net income. So it's a real differentiator for Costco. But at the same time, they continue to grow the warehouse footprint, fueling continued growth in the membership fee.
So let's get to what could potentially go wrong with Costco. One is they decide not to raise the membership fee anytime soon. And secondly, there's the other piece of what you talked about, that they don't expand the warehouse space as much as anticipated.
100%, although this one I would say is very low.
Gotcha.
If only because the management team over the last several conference calls, when they report the earnings, have said, yeah, it's just a matter of time. We will do this, and I think when we get it, you'll see earnings expectations move higher, price targets move higher as well.
Gotcha. And what about the second one?
Well, look, if we start to see interest rates come down, I'm thinking one Fed rate cut later this year, a couple more next year, that's going to help improve their hurdle rates. I do think that there's room for them to continue to expand, not only in the U.S., Canada, call it North America, but also outside. They've only got a handful of locations in China and other territories that you could see even greater penetration.
All right, so let's get to the stock you don't like as much here in the food area. We're talking about McDonald's. These shares are down about 10, 11% over the past year. So it's sort of the converse, or the inverse, if you will, of Costco. The people are not eating fast food as much.
Right. And it's two parts, right? So as we talked about, people are not eating out as much. They're feeling that pinch, but at the same time, take a look at what we've seen for price increases in fast food, where in some cases it's almost on par with fast casual, right? A Chipotle or something like that. It's no longer the cheap alternative.
Interesting. Even though, they have They have rolled out the value meals, though. I mean, now there's sort of a value meal war going on.
Yeah.
You don't think that's going to be enough?
Well, to begin with, there's the, what is it going to cost them on the margin side? And at the same time, there's the competitive response. So how long does this go on for? That's my bigger concern, right? Leading with price, good in the short term, but it's very hard to kind of drive those margins higher over time if you're leading on price.
Well, especially as they still have wage pressures wages are not going down, certainly, for fast food workers. And so the margins they don't have a lot of flexibility, I guess, on margins if they're offering these value meals.
Well, so there's a couple things here, right? So you are 100% correct that wages are going higher. Take a look at what's happening in California. That's really going to hurt them. I think Brian Sazi posted something about that yesterday. But at the same time, we could look at ADP's monthly pay change data. Job stayers 5% year over year, pretty consistent the last several months. Job changers even higher. But you talk to some of these hiring managers at local McDonald's or other fast foods, still very tough to find people because of what they want in terms of wages. And then at the same time, we've got other dynamics at play here where if these companies want to overcome this productivity issue, they have to invest, whether it's AI, robotics, what have you. So you're having margin pressure, but you've got to invest at the same time. Something's got to give.
Yeah, interesting. Okay, so what could go right here? Maybe a little bit of an alleviation of input costs, which we've seen some of.
We have. I mean, beef prices, chicken prices have started to come down. When you think of McDonald's, burgers and chicken, that could be helpful to them, but I think that's going to be offset by some of the factors that we talked about.
Gotcha. All right, so let's just quickly tell folks what positions you have, if any, in these two.
Sure. So in the Street Pro portfolio that I manage, we are long Costco shares. We've got an $8.80 price target, but we think once we get that price target, once the membership fee increase comes through, we're likely to raise that. And McDonald's, I would say simply, Julie, not loving it. And we actually sold the position in McDonald's that we had very early in the year because of some of these concerns, particularly about the minimum wage increase in California.
Okay, interesting. Chris Versace of Tematica, good to see you.
Good
Thanks
to see you.
for coming in. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.